Welcome back to RegTalkUK, the deep dive that helps you, the UK banking professional, stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie. And this week, well, we're looking at a system under, frankly, immense pressure. It feels caught, doesn't it? Between sort of state control, market innovation, and some pretty harsh economic realities.
Yeah, definitely. Our theme captures it, I think, the canary and the jewels. And we're starting with this, well, almost unbelievable parallel.
It really is striking.
So on one side of the channel, you've got Parisian prosecutors scrambling after millions in jewels vanished from the Louvre. We're talking $88 million worth, apparently, because security just failed.
Mm-hmm. Power tools involved, I read?
Exactly.
Yeah.
Meanwhile, over here, Andrew Bailey's warning Parliament about a completely different kind of a different kind of warning signal being missed.
And that's the crux, isn't it? Both stories are about a vulnerability that was either missed or maybe worse, ignored.
So the Louvre security fails, thieves walk off with diamonds.
Right. And in finance, Bailey's Canary, well, it's not the cheerful yellow sort, is it? It's the one that drops dead just before the whole mine collapses, signaling a potential failure worth far, far more than those jewels.
Okay, let's dive straight into that alarm bell. In segment one, this echo of 2008 in the private credit market, it sounds genuinely scary.
It is the lead story, I think, mainly because the language from the bank's leadership was so, well, stark. Unusually so. Governor Bailey went before the House of Lords committee.
Right.
And basically questioned what's happening with these recent bankruptcies.
He actually asked, didn't he? I've got the quote here. Are these cases idiosyncratic, or are they what I call the canary in the coal mine? That's pretty direct from the governor.
Hugely direct. It screams systemic concern, not just, a couple of firms going under.
And the triggers were those U.S. firms, Tricolor and...
Tricolor, the subprime auto lender, yes, and First Brands, a car parts supplier. But the real worry, the thing making Bailey and others really uncomfortable, is how the risk is structured. It feels horribly familiar.
Like 2008 familiar. We spent, 15 years trying to fix securitization, stop those hidden risks building up?
Mm-hmm.
Are they saying it's happening again, just outside the regulated space?
They're saying the spirit of it is back. Maybe not the exact same instruments, but the same problems. Because the controls on banks, well, they don't really reach deep into this private market stuff.
Right.
Bailey specifically said alarm bells start going off when he saw the return of things like slicing and dicing and tranching of loan structures.
So structured finance, but kind of in the shadows this time.
Exactly. And the killer is the opacity. Sarah Breeden, the deputy governor, was even more blunt. She said, quote, "We can see parallels with the global financial crisis."
Wow.
Yeah, pointing to lack of transparency, too much leverage, weak underwriting, all the old hits. But crucially, these are illiquid private assets. Their value isn't clear day to day.
And UK banks aren't totally separate from this, are they? Even if it's private credit, the risk finds its way back through insurance, maybe pensions.
Absolutely, it's interconnected. Look at Barclays. They immediately flagged a £110 million hit just from that Tricolor collapse.
Just from Tricolor.
Yep. And their total exposure to this whole opaque private credit world, around $20 billion. That's a significant chunk sitting there, potentially quite risky.
It makes you think of Jamie Dimon's line, doesn't it? When you see one cockroach, there are probably more. Tricolor isn't the problem itself, it's what it signals about everything else under the surface.
And the Bank of England clearly thinks there are more cockroaches. They're launching a massive stress test across the whole sector. Banks, insurers, private equity firms, everyone involved.
That'll take time, though.
9 to 12 months, they reckon. But it shows they think this is structural, not just a couple of one-offs.
Okay. That drive for more visibility, more control. It links nicely to our next bit, segment 2. This big shift in who controls anti-money laundering oversight.
Yeah, if private credit shows regulators wanting broader control over risk, this shows them wanting tighter, more centralized control over financial crime. HM Treasury's basically decided the FCA is going to be the Single Professional Services Supervisor, the SPSS, for AML and CTF.
SPSS,
Yeah.
Right. Sounds a bit dry, but the shift in power here is huge, isn't it?
It's fundamental. You're taking supervision away from, 23 different bodies, 22 professional groups, plus HMRC, and putting it all under one roof, the FCA's roof. They'll now oversee something like 60,000 firms, lawyers, accountants, trust services, the lot.
So why should, our listener in a bank care if the FCA starts regulating accountants more closely?
Because the whole point, the government's rationale, is that fighting financial crime, that's the state's job, not something for fragmented self-regulation. So, for you listening, the key thing is those professional firms you rely on for due diligence, for that stamp of approval on tricky deals, they're about to face the FCA's enforcement machine, which means standards for things like source of wealth checks, client due diligence, they're likely going up and becoming more standardized.
Blimey, just harmonizing the rules from 23 bodies. That's not a small job. That's a massive overhaul.
It is. And people did raise concerns during the consultation, about splitting AML oversight from other professional standards like conduct. Could you lose the holistic view? But the decision's made. Centralization won. The state wants tighter grip on that particular jewel, financial integrity.
And speaking of the FCA flexing its muscles, segment 3, the motor finance war. This just keeps rumbling on, doesn't it? And it sounds like it's getting nasty.
It really is. It's gone beyond regulatory argument into, well, a full-blown political and financial battle. The FCA's plan for redress for those undisclosed commissions, it's pitting them directly against the big lenders. And the numbers are just staggering.
What are we talking overall? The estimate is 11 billion.
11 billion pounds, yeah, across potentially 14.2 million finance agreements. Average payout around 700 quid per person affected. It's enormous.
You can see why the industry's pushing back so hard.
Oh, absolutely. Charlie Nunn at Lloyds warned it could wipe out 20 years of profitability for the car finance sector. 20 years. And he even mentioned an investability issue for the UK.
Crikey. And Lloyd's own numbers reflect that pain rate. Profits down massively.
Down 40%. Their provisions are nearly $2 billion now. Barclays added another $235 million, taking theirs to $325 million. It shows the cost of getting conduct wrong, doesn't it? It's punitive.
And it really is. It's like the price for retrieving that jewel of regulatory trust.
Yeah.
But is the FCA risking destabilizing things by hitting them so hard?
Well, Nikhil Rathi at the FCA isn't blinking. His line is firm. Firms and lenders broke the laws and rules that were in place at the time. End of story, basically. The consultation closes November 18th, but I wouldn't expect them to soften the final approach much.
This really feeds into that new enforcement doctrine we heard about from Therese Chambers, doesn't it? Cooperate or face the bitter end.
Exactly. It's a very pragmatic approach. Focus resources, get results. They've actually cut the number of open investigations from about 220 down to 124.
Really? Fewer cases.
Fewer open, but they're closing them much faster. Average time down from, 42 months to just 16 months? So the message is, if we start, we will finish.
So what's the actual carrot for a firm if they're potentially facing huge redress costs anyway? Why cooperate quickly?
The carrot is a potentially lower fine and just getting closure. Chambers give examples. Barclays got a $3 million fine instead of maybe £6 million on one case because they played ball, paid redress voluntarily.
Okay.
H2O Asset Management avoided a fine altogether by working with the FCA on a $250 million investor redress package. So fix it fast, pay the redress, and you might save on the penalty.
And the stick, if you fight it.
The stick is, well, look at the Barclays Qatar case. That dragged on for a decade. The FCA just kept going until Barclays finally dropped its appeal and paid the $40 million fine. They will see it through to that bitter end if they have to.
Right. Okay, let's switch gears slightly. Segment 4, technology. And this clash between tech disruption and, well, traditional banking models, the AI paradox.
Yeah, this one's fascinating, isn't it? Because banks are pouring money into tech that could potentially completely gut their core profit engine, customer inertia.
How so? I mean, the efficiency gains are obvious first, right? Like Lloyds using that Microsoft Copilot.
Definitely. Lloyds surveyed their staff, found it saves the average user 46 minutes a day. Summarizing documents, prepping for meetings. That's a huge internal win, cuts costs.
46 minutes is massive.
But the threat.
The threat is external and potentially existential. McKinsey put out a report warning about agentic AI. Think autonomous software agents acting for the customer.
Right. They reckon these agents could automate switching people out of low-interest savings accounts into higher-yield options instantly, undercutting that whole model where banks rely on people just not bothering to move their cash. They estimated the global cost at $170 billion.
Wow. So banks are funding the tech that teaches customers, or their agents, how to ditch them for better deals elsewhere. That's quite the paradox.
It's the ultimate irony, isn't it? It basically weaponizes customer awareness against the bank's own business model. It forces banks to proactively compete on rates and service before the AI switches everyone.
Alongside AI, we've also seen this total U-turn on crypto, haven't we? It's going mainstream, like it or not.
The regulators have basically thrown in the towel on banning it for retail, yeah? The FCA's lifted its 2021 ban. You've now got Big names, BlackRock, 21 shares, WisdomTree listing Bitcoin ETPs right here in the London Stock Exchange.
Which mirrors what happened in the U.S. It feels like regulatory control just couldn't hold back the tide of innovation and institutional demand there.
It confirms it's a global shift now. Even Christopher Waller at the U.S. Federal Reserve said recently that crypto is now woven into the fabric of the payment and financial system.
So regulators have to engage, even with all the headaches that brings. Compliance, market manipulation.
Exactly. They have to find ways to manage it within the traditional system now.
Okay, finally, segment 5. Quick hits, some crucial resilience points here. First up, that AWS outage.
Yeah, the big Amazon Web Services wobble that hit Lloyds and even HMRC. It really highlighted how dependent key services are on these big cloud providers.
And it raised a big regulatory question, didn't it?
It did. The Treasury Select Committee shot off a letter to HM Treasury asking, basically, why isn't AWS designated as a critical third party yet? The CTP regime kicked in back in January 2025.
And that designation matters because
Because it allows the PRA and FCA to impose direct resilience standards on AWS, even though they're a U.S. firm. It forces them to meet UK stability requirements. Without it, well, you're relying on their goodwill, essentially.
Okay. And while they want operational resilience from tech firms, they're also digging in on capital resilience for banks.
Absolutely. Sam Woods at the PRA, in his final Mansion House speech, was very clear. He pushed back hard against ideas to weaken the leverage ratio, like removing sovereign debt from the calculation.
He had quite a colorful phrase for it, didn't he?
He did. He said it would undermine hard-won resilience and compared it to ripping off your jacket and throwing it over a cliff. Doesn't sound like he's keen.
No. Suggests any push for deregulation on capital will meet stiff resistance.
Definitely. And remember, the backdrop to all this, the economy is still shaky. UK public borrowing hit a 5-year high in September, $20.2 billion. So there's just no room for error if that Canary Bailey's watching does. Keel over.
What a week. Okay, let's recap. The Louvre loses its jewels, maybe through negligence. The financial system has $20 billion exposed in markets it can barely see into. And Andrew Bailey's Canary is definitely singing, and it sounds a lot like 2008.
The dilemma is stark, isn't it? You've got regulators trying desperately to centralize control, AML, enforcement, CTPs, while fighting these huge fires like private credit and motor finance redress.
Billions of pounds worth of fights.
Exactly. But at the same time, unstoppable tech like AI and crypto is just rewriting the rules of the game faster than anyone can keep up.
Which leaves us, and you listening, with that core challenge, that trilemma. Can the UK really be a world-leading innovation hub and impose this much tighter, centrally managed supervision at the same time?
That's the billion-pound question, isn't it? Or maybe the trillion-dollar question now. Getting that balance right, that's everything for the next few years.
Indeed. Right, that's all from us this week on The Deep Dive. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.